The 95% of traders will never get to know this ICT secret, and it is in fact the easiest path for becoming profitable trader and never again experiencing how the market takes every cent from you once more. So pay attention, I'll teach you this concept that feels like cheating because you will never see the market the same way again. In the next 20 minutes, I'll talk you about the most basic and common ICT concepts and how this way of understanding them and knowing them, of identifying them on the chart, is essential. It's something you didn't know until today, and you'll wonder, how did I not know something this important? I'll mainly talk about three of them and the most popular ones in smart money concepts: fair value gaps, order blocks, and break of structure. And I will explain them in a way so simple and easy that with a little practice you'll be an expert at mastering those relearned concepts. And afterwards, I will show you real examples in the market of how this secret I'm talking about looks like. It's getting cold here. Now, why it is so urgent? What can really make such a huge difference? Why do you need to understand them? What changed so much the way you trade? Let's start with the first one and my favorite, the order block. We understand that the OV is a zone of institutional order loading, and it looks like a candle of the opposite volume before a trend. It's simple, straightforward, easy to understand, but I will tell you what an OV really is. A true order block, one that the market will never reject, is that OV that generated an accumulation, that concept that comes from the Wyckoff method. But since this video focus on ICT, I'll be brief in this matter. An accumulation is a place where institutions load their orders before advancing into expansion, meaning the explosive zone where the market moves strongly. And OVs are nothing more than hypersimplified accumulations, or easy to spot in the market. And true order blocks are the ones that have extensive order loading behind them. And I'll talk to you about three things right now: why that order loading zone is so important, why price really respects it and returns then, and it is really an OV or does it end up being something different? And that last question leads to an even more interesting one. Which are the best OVs and the ones price respects the most when making pullbacks? We'll go with 3 and 4 fears because they really spark curiosity. And even though they are the last ones, they are the most important ones. Is a song like that really an order block? A bunch of candles group one after another? That's a very different concept from what we're used to. And actually, yes, it is. In fact, it's fun to say it because this accumulation zone is an OV on H1, H4, M13, M15, even if you're scalping handling London or Asia. It's an OV on M5. And that's right, inside order blocks there is an extended accumulation zone, and you should not consider anything an OV if there isn't an accumulation of some kind in there. That's what really composes the nature that allows us to use OVs for trading, and this takes us to the fourth question, which is partially answered. What is the most important type of order block? Obvious, the 1 hour, 4 hour, or 30 minutes time frame. The higher the time frame, the more important and likely it is to expect a reaction there. Yes, I knew this when I was a beginner, but I didn't know why it's more important. And this is what I want you to understand. And for that, I'll answer question 1 and 2. Why is that order loading zone important? We now understand that this accumulation is an OV of a higher trend. In our time frame, if it looks like an accumulation, it's because it's an OV in a higher time frame. The reason it's important is because it's the place where institutions reach a consensus and decide that right there and at that price they will buy or sell orders before the next strong movement. Therefore, it's a place where they stop in order to make their moves. If they loaded orders in an accumulative manner and then push price downward, making it fall by spending all that liquidity and leaving less energy for the movement, they will take advantage of price going up and they will return to buy more orders in that order block. And this begins to cover the fourth question. And this is basically it. They will take one of two choices. They will stop orders so that price do not advance further from there because it's a level they protect. Or in the other way, they will buy more orders. They will have limit orders ready that activate when the level is touched, and then they induce price downward again, benefiting and loading orders at that price. That is why those loading zones, those OVs, are important. They are zones you will see them protect over and over or use those famous order block retests, and exactly that, loading more orders, therefore of continuation signal. They are zones you will see them protect over and over or use those famous OV retests, are exactly that, loading more orders and therefore a continuation signal or defending that level. There are more ways to recognize if it is a confirmation of continuation, but that's why and how that level works. And expanding the fourth question, price respects and returns there because the institutions that place their orders, they're decided that price is convenient for them during the duration of that direction. Precisely because of that, an important signal is generated when an order block like this is broken, when it is dragged by liquidity as it moves forward, or has only a small reaction there as price advances. Those are just retail orders stopping the flow of the real direction price will follow. Institutions might use it in the future as a loading zones, but when that level breaks, it shows they lost interest in the direction they had and are going the opposite way. Because by looking only at established zones, order blocks in higher timeframes or accumulations in our timeframes, we will see a zone that maintain order and coherence in the movement. Observing, seeing, and reading OVs in this way is a definitive way to really know where they are, what sounds they care about, what directions price really seeks to follow, which order blocks are valid, and the ones you really need to pay attention to in price. And for this, of course, I will show you examples of how it works in the market and with real examples. Before that, I'll take the liberty of explaining how break-off structures and fair value gaps work. First, break-off structure, which is very simple and adds to what I told you before. It is generally believed that it's used to know that price direction will continue in trend, breaking a low with a new low or a high with a new high. But it's more than that. Institutionally, a break-off structure is only valid when an accumulation structure is broken. It could be a signal that sometimes happens where breaking a low continues the trend, but it will without a doubt not be even half as accurate if you consider it's breaking an important level such an unestablished order block, where there was a broad loading of orders. That is truly relevant break of a structure. And again, I'll show it on the chart, but first let's see how an fair value gap really unfolds. Fair value gaps or inefficiencies, we have the idea that they are levels where price left a void. But what a void of what type void? What really is the void and for who? And if it seems like a high probability zone, why does it sometimes feel and other time it is simple ignore? For traders, it doesn't represent a void because the broker will always give us the closest available price. But through the interbank system handled by large institutions, there in the fair value gap, there is a gap where they could not finish loading their orders. It's a zone where price moved with such speed that they didn't have the chance to finish loading their orders. That is the void, a void of unloaded institutional orders. Now, if it is a place where they had to load orders and they didn't, why does price sometimes not return there? What does it sometimes only partially feel or just touch the beginning of the fair value gap? This is very important to mention. When these institutions couldn't fill all their orders there is definitely an issue. Why do they ignore it? Simple, because there is something that benefits them much more on the other side. When they live without feeling an FVG or barely touching it, it makes it very clear that they have something that benefits them much more on the other side. They don't need to go there. They already found their next gold mine somewhere else in price. So they won't return to the fair value gap. They don't need it. They found a better opportunity. And what this clearly tells us is that when a fair value gap is ignored, it's a powerful indicator of the real direction of price. Keeping in mind what a fair value gap, an order block, and a break of a structure really are, the next thing is to see it, truly observe how the market show that these three essential of smart money and ICT behave in a way you didn't know before. So let's go straight to the examples with real market. I will show you first how accumulation in lower time frame is effectively an OV in higher time frame. Not every case is a perfect single candle, but it's clearly an OV, and they are important because they are recurring price zones just as I explained earlier. Let's look at a simple comparison between a smaller one and an H1 one. OV from June 26 at 1 p.m. 6 touch, one after another during 4 days, a clear level that was respected again and again. And how does it look on M5? An accumulation, just as I told you. Now let's compare it with a simple OV on M5 or M15 as you would normally see it if you don't look for the accumulation behind it when orders are loaded. And here we find the perfect example. In this trend, we can see it's going in cells and we have two classics, OV, ICT textbook, one lower. As you can see, in the first one, there is a classic touch and rejection. In the second one, the rejection happens slower, and here occurs what happens to some people trading this method. They don't get to enter because price never reached the OV itself. Now, what will happen if we zoom inside what's happening in these two? This is extremely interesting, so pay attention to what we can see. In the first order block, it's not so clear, but you can still see that the green candle is not the one that generated the reaction, but instead these two zones here, where there was a very brief accumulation. And on this line is where the next high reacted, and that high in turn was an accumulation. Prices stopped there to load more orders at that price and drop. And if we look at the second one, it's absolutely amazing to see that it aligns with the previous accumulation. The margin where it reacted was that accumulation at its beginning. It didn't accumulate anything. It just touched and they pushed price down because they didn't want the trend to move from there. If we look at this on M15, we can see it's an entire zone and the high touched exactly the edge of that zone. There were two accumulation zones, the first OV which barely touched and the second which feels completely unstopped there. And observing volume, I can clearly see it absorbed traders who fell into the trap, people who positioned long and were wiped out. They tried to push but couldn't, and the market fell without resistance from there. Let's see another example nearby. Further down on the chart on M5, we observe a small accumulation, a cluster of candles. If we open it on M1, we see what's behind it. It has three different levels of accumulation that connect with a previous zone where there was extended accumulation. It's a level, a channel with institutions previously load, and here they load again because it's a convenient price for them. These are the OVs that truly establish a precedent for where to expect a reaction and whether it will be a rejection or continuation. They are clear and obvious statement of intention. So let's go straight to break of a structure. Simple, not complex at all once you understand what a true order block looks like. Let's see a clear one close to the previous example. The accumulation that was created is broken with great force, absorbs a lot of liquidity visible in the volume, and then it turns and goes into buys. There was an accumulation that signaled H1, it's interesting because one might consider this red candle the OV. No, what validates the OV is this accumulation of order loading that came after that red candle. And when this level broke, when the direction continued, a break of structure was generated, one that is absolutely reliable because if the market abandoned such a broad loading zone, it absolutely means a strong impulse. So let's talk about a simpler break of structure without so much preparation. Same day above that trend. There is a clear accumulation, a resistance zone where you can already see how buying strength ends and they need to absorb resistance to keep pushing. So they stop here to do so. It can be seen as an OV on M15, but if we look at it on M1, it's a clear accumulation. When the high of that accumulation broke, a valid break of structure was generated, which could give a short trade but not much more. It's the exhaustion zone of that trend, a very inconvenient place to keep buying unless you're seeking a small target. That simple structure and as such a break of a structure doesn't seem valid to me to take trades based solely on it. There are ways to make sure a break of a structure is stronger or real, and it is important that it comes from a strong accumulation level, or a broad one, I'd say. Because in this case, from the previous OV we talked about, the accumulation broke but immediately returned after that. So a break of a structure on M1 tends to not be very valid. From visible accumulation on M5, it's much more reliable when deciding to take a trade together with other factors. And this same VOS seen from M5 was broken only with a wick. That it's not a real break and it could be completely avoided until there is a break with a candle body, of course. Having these standards when locating a break of a structure will make things very different when trading the market because we will be hunting real signals with a high probability of giving us positive results. So let's talk without more delay about the last concept for today, the fair value gaps. As I said, it's a zone that moves so fast that through the interbank system, institutions don't have the chance to fill their pending orders and it is an inconvenience zone for them. So they will look to fill it or they will ignore it if they have something better waiting ahead. But there is one thing I didn't tell you before. A second reason why they won't return to fill the inefficiency is because they already loaded orders before and don't need to do it there. Two quick examples of this are close to the previous OV and breakoff structure. We will look at them on M15, where it's much easier to see the real size and boundaries. On M5, it's already visible, but on M15, it's a crystal clear to see it. The first real gap comes right after prolonged accumulation. They don't care at all about filling it. They loaded orders for 3 hours. They won't lose anything by not doing it there, so they ignore it completely. Simple as that. Second example, they had two previous levels to load orders, and if you ask me personally, this entire zone was passive order loading for sales. By the time the fair value gap happened, it wasn't very large and they had already loaded. So it is irrelevant to return to it to fill it. Totally unnecessary for them because the work was already done way earlier. So let's go to an example where an fair value gap was filled. And this one gives us an important information. So what is it? Institutions gives the push and absorb, but they are not the ones who sustain a drop. It's retail and people executing panic sales or euphoric buys. In this case, they absorb a lot of liquidity from this upper level and the market pushes strongly downward. It doesn't even look like just institutional push. It's a drop supported by real seller strength. And when it reached the bottom, it was completely absorbed. Institutions took everything and effortlessly pushed upwards, filling the fair value gap, which was caused by a force they didn't foresee. And afterwards, we observed that this was the accumulation level, exactly where that spontaneous fair value gap formed. It's a clear example of where they want to push price and where they hold it. Let's see another example similar to this and one where the fair value gap fill is more immediate. This example is much more complex. We're in a scenario where New York's closed, Asia opens, and at that moment they push price up with bearish pullbacks, taking out position buyers. When they take them out and have a free path making people believe they'll continue buying, they take them out again, simulating sales twice. But the second time, they couldn't stop the retail liquidity push, which generates a clear fair value gap. But they didn't go up to fill it, even though they already had the liquidity they manipulated. They stayed consolidating below. Why? Because they had an impactful news event later, which they will take advantage of afterwards. So, seeing it convenient to keep accumulating orders at this level and manipulate during the news before going in buys, they end up filling the fair value gap. Although you couldn't really say they filled it, I will say they completely skip it because they found a much better opportunity below it and not necessarily one where retail traders could take advantage of. These chaotic movements combined with news I like to call massacres, and they are the worst places to place a trade. The third example of instant fair value gap fill is attached to the previous example. After generating a buy impulse following the high impact news, the market moves strongly and leaves a clearly inconvenient gap because the market doesn't delay to fill it the moment it is created for two reasons: order loading and liquidity capture there. All the stop loss of those who were in long and now are victims once again. And this level can be an easy fill target because the last time they accumulated was far from the current price point. So in this fair value gap, it makes sense to expect this coverage, especially with the liquidity injection caused by the news. And so, having this absolutely privileged information on how institutions react to fair value gaps will allow you to have a different perspective of how they do things and when. Complementing the three concepts, you will have even more opportunity because you will see the true complete picture. If you like this video, please subscribe and like the video. And I invite you to watch more videos with information as valuable as this. I hope we see each other again.